War, oil, gold, and the dollar. A systemic power analysis. Chapter 1. The illusion of simple casualty. The framework we are trying to construct, war in Iran leading to oil shortages, strengthening the US dollar, weakening gold, is too linear to survive contact with actual market structure. These variables do not interact in a straight line. They operate inside a layered system where liquidity, expectations, and power projection dominate physical supply shocks. The first failure point in our thinking is overestimating the role of physical scarcity and underestimating the role of financial architecture, as well as global capital flows. Oil supply disruptions matter, but markets price future expectations, not just present constraints. Similarly, gold is not reacting to barrels of oil lost, but to real interest rates and systematic stress. The model collapses because it assumes commodity markets behave like isolated systems. They do not. They behave like reflexive financial ecosystems. Chapter 2. Oil as a trigger variable, not the outcome variable. Oil is not the end of the story, it is the initial disturbance. When conflict involving Iran escalates, the first concern is disruption to flows through the Strait of Hormuz. This choke point carries a significant share of global oil exports. Any threat introduces a risk premium into oil prices. However, the mistake is assuming that physical disruption must occur for prices to move. Markets move on probability weighted scenarios, not realized shortages. Even a 5 to 10% perceived probability of disruption is enough to move oil significantly. Once oil rises, it transmits into the broader system through inflation expectations. Energy is the foundational input across transportation, manufacturing, and food production. Therefore, oil price volatility converts rapidly into macroeconomic uncertainty. At this stage, the system transitions from a commodity shock to a monetary policy problem. Chapter 3. Inflation transmission and central bank reaction. The second order effect of oil shock is inflation. When inflation expectations rise, central banks, particularly the Federal Reserve, face a constrained decision space. They can either tolerate inflation or maintain tighter monetary conditions. In most modern scenarios, especially post 2020, the bias has been towards maintaining credibility through tighter policy. This is where our interpretation begins to break. The strengthening of the US dollar is not caused directly by oil shortages. It is caused by relative interest rate differentials and global demand for yield bearing safe assets. If the Federal Reserve signals that rates will remain high or higher for longer, capital flows into treasury markets increase. This strengthens the dollar regardless of where the war is geographically located. Thus, the causal chain is not war, oil shortage, USD strength. The correct chain is war, oil volatility, inflation expectations, tighter monetary stance, capital inflow, and USD strength. Chapter 4. The US dollar as a liquidity weapon. The US dollar is not merely a currency, it is a core statement. It is a core settlement layer of the global financial system. Most international trade, particularly oil trade, is denominated in USD. During periods of uncertainty, global actors, banks, governments, institutions require dollars to service debt, settle trades, and maintain liquidity buffers. This creates a phenomenon known as flight to liquidity, which is more powerful than flight to safety. Our analytical analysis has a weakness which conflicts safe assets with gold. In reality, the first safe asset in any crisis is cash in the dominant currency, which is USD. Gold is secondary. It is a hedge against systematic breakdown, not a tool for immediate transactional stability. Therefore, during early or moderate stages of geopolitical conflict, US often strengthens even as risk rises. This appears counterintuitive if we assume that gold should always rise during war. It does not. Gold rises when confidence in the monetary system weakens, not merely when conflict exists. Chapter 5. Gold's position, a derivative of real yields. Gold is not reacting to war directly, it is reacting to real interest rates, which are the difference between nominal rates and inflation. When real yields rise, gold becomes less attractive because it generates no income. When real yields fall, gold becomes more attractive as a store of value. If oil driven inflation rises but central banks raise rates aggressively, real yields may still remain positive. In such a case, gold doesn't necessarily rise. This is the contradiction where our models fail to resolve. We are treating gold as a direct hedge against war, when in reality it is a hedge against monetary instability and negative real yields. Gold only enters a strong upward phase when one of the two conditions is met. Either central bank lose control of inflation and real rates turn negative, as well as when systemic risk escalates to a level where confidence is in fiat currencies erodes. Short of that, gold remains constrained. Chapter 7: The Strategic Role of Diego Garcia. The inclusion of Diego Garcia in our framework introduces a different layer: hard power and logistics. Diego Garcia is not an economic variable, it is a force projection asset that allows the United States to maintain operational reach across the Indian Ocean and the Middle East. Its relevance lies in reducing the probability of sustained disruption. By maintaining air and naval superiority, the US can deter or respond to attempts to close any maritime routes like Hormuz. This stabilizes expectations around oil supply even during conflict. Market price not only risk but also capacity to manage risk. Diego Garcia represents that capacity. Our implicit assumption that war automatically leads to prolonged supply disruption ignores the existence of military infrastructure designed significantly to prevent the outcome. This is a second order value in our reasoning, ignoring countervailing power structures. Chapter 7: Interaction Dynamics: Oil, Gold, USD under war conditions. The interaction among oil, gold, and the dollar is not static. It evolves across phases of conflict. In early stages, uncertainty rises but systems remain intact. Oil may spike, USD strengthen due to liquidity demand, and gold remains volatile or capped due to high real yields. In intermediate stages, if inflation persists and growth slows, central banks face a dilemma. If they pivot towards systematic easing, gold begins to rise as yields decline. In extreme scenarios where financial systems are stressed or credibility erodes, gold enters a strong upward phase, while the dollar may strengthen or weaken depending on the nature of the crisis. The system is therefore non-linear and phase dependent. Any attempt to reduce it to a single directional rule is analytically weak. Failure points in our model. The current model falls at three levels. First, it overweights physical supply shocks and underweights financial flows. Second, it assumes linear causality in a reflexive system driven by expectations. Third, it ignores the role of institutions and military infrastructure in stabilizing outcomes. If we continue using this simplified framework, our forecast remain will be systematically misinterpreted. If the conflict involving Iran continues without major escalation, the most likely outcome is persistent oil volatility, elevated inflation expectations, and continued support for relatively strong USD. Gold may remain range bound or experience episodic spikes without sustained breakout. If the conflict escalates to a point of disrupting global trade routes significantly or forcing central banks into policy reversal, then gold gains structural momentum. This would require either sustained negative real yields or systematic stress, not just localized war. If the US monetary policy remains restrictive and global capital continues to seek yield, USD strength will dominate and gold will struggle to maintain upward momentum despite geopolitical noise. The relationship we are trying to analyze is not commodity driven, it is power driven. Oil initiates shocks, central banks interpret them, financial markets price them, military infrastructure contains them. The US dollar sits at the center because it is embedded in every layer of the system. Gold exists, pardon, gold exists outside the system, but only dominant when the system itself is questioned. Gold exists outside the system, but only when dominant gold exists outside the system, but only becomes dominant when the system itself is questioned.